Hey guys, it's Terry and you're watching Invest Roundup. Just when we think the market cannot get any more chaotic, it did. Another company came forward with a vaccine of their own, AstraZeneca, but unlike Pfizer and Moderna, the news is strangely having an adverse effect on the company's share price. And to make things worse, the company is now dealing with the news of a major manufacturing error. Nonetheless, news about vaccines are lights at the end of a tunnel for global travellers and tourism-related companies. In fact, Qantas and Virgin was recently playing a major game of tug-of-war for customers. Meanwhile, netizens in India are faced with a thinning list of Chinese apps to use as the blacklist on Chinese company widens, recently axing a few Alibaba apps from the country. And will Joe Biden's presidency turn things around? Nevertheless, let's dive into this week's news. Disclaimer: whatever stock or news we talk about is not a recommendation to buy or to sell. These are all just news we deem important, things we think you need to know about if you're invested in the stock market or if you intend to invest. First news item: stock market celebrates Joe Biden. The stock market is celebrating Joe Biden's victory against Donald Trump in the recent US election. The day after Trump's administration effectively acknowledged the election of Joe Biden, US's two major stock market indexes were pushed to their all-time high as investors embraced the end of political uncertainty, which has kept the country in limbo for weeks. The masses were also relieved after it was revealed that Joe Biden has nominated Janet Yellen to head the Treasury Department. Starting with the day after Trump's and Biden's election day, November 8th and 3rd respectively, Trump's election saw a 4.3% increase in the Dow, while Biden's has seen a 9.3% increase over the next 3 weeks. The S&P 500 was also up around 8% since Biden's election, the second best gain in 90 years, and nearly triple the advance after Trump's election in 2016. In fact, Biden's first 3 weeks in the stock market have been historically solid when measured against newly elected presidents in the past. Undeniably, news about vaccine discoveries have also fueled optimism, especially in stocks that had been impacted by the outbreak, as investors are expecting an economic recovery. That's why we're also seeing airlines and oil stocks soar in November, with United Airlines, American Airlines and Delta Airlines climbing by more than 30%, whereas Chevron has increased by almost 38%. This interestingly brushed aside Donald Trump's long-time claim that his presidency has strengthened the stock market because the Dow Jones Industrial Average has actually been stronger, with Biden becoming the president-elect versus Trump when he was elected in 2016. Investing legend Byron Wien, however, told CNBC that the stock market may be getting ahead of itself. He was also quoted saying that we're in a long cycle that's going to last several years, and long-term investors will be rewarded if they are patient and hold on. MarketWatch also dropped an article to warn investors against zombie companies amid the frenzy, which are companies with interest coverage ratio of less than 1 for 3 years. Second news item: AstraZeneca catches up with the big boys. Early last week, we were greeted by yet another vaccine news, this time by Big Pharma AstraZeneca. This is the third week in a row where we started Monday with vaccine discovery news. Unfortunately though, unlike Pfizer and Moderna, this news has brought an adverse effect to AstraZeneca's share price, and the company's value declined by roughly £8 billion. And this was strange. Clinical trials so far has shown this vaccine to be safe. It helps prevent the spread of coronavirus in asymptomatic patients. It is far cheaper to produce compared to Pfizer and Moderna, and it only needs normal refrigerator temperatures, unlike Pfizer, which requires its vaccine to be stored at -70 degrees or -94 Fahrenheit and below. So why did this happen for AstraZeneca? Maybe it's because the company has pledged to distribute the vaccine at cost price during the course of pandemic, which means it won't profit from the initial orders received from governments and international bodies. Maybe it's also because of how the news has been headlined. Initial results show the first half dose is able to provide 70% protection against the virus, but the secondary full dose of the vaccine saw immunity rise to 90%. Shareholders, however, appear to have taken 70% efficacy a little too seriously. Next to their counterparts who posted efficacy levels above 90%, AstraZeneca's vaccine appears much less efficient at a glance, and the shares slipped by 1.76% on the same day. Another possible reason for this price slip could also be due to the questioning by former pharmaceutical executives in the US about the company's testing methodology for the vaccine. The executives have been quoted saying, "We believe that this product will never be licensed in the US." An AstraZeneca spokesperson had since defended themselves, stating that higher standards were used. An additional analysis will be conducted on the vaccine and its results. Developers of Sputnik V COVID-19 vaccine from Russia have also gotten in touch with AstraZeneca, proposing to combine the two vaccines to boost efficacy. The Sputnik V is claimed to be 92% effective in protecting people from COVID-19, according to the interim trial results. AstraZeneca's share price was down by around 8% the whole of last week, but overall, the company's profitability is still looking pretty good last quarter. By the way, before we go to the next news item, click on the subscribe button below now so you'll be informed the next time we upload a new episode. That way, you won't miss any important market news. Third news item, Qantas and Virgin Australia's tug of war for frequent flyers. Australian airline Qantas recently started a war with Virgin Airlines targeting the top-tier members of their loyalty program. According to Bloomberg, Qantas launched the attack on Virgin Australia just days after Bain Capital took control of the airline in a $2.6 billion deal, which fell into voluntary administration at the beginning of the COVID-19 pandemic. Frequent flyer programs have since emerged as key cash-generating assets at airlines hammered by the pandemic, and Qantas, seeing the opportunity, is attempting to lure members of its frequent flyer program to switch allegiance. The Australia's national carrier said it's offering top-tier members of other airline loyalty plans the chance to fast-track their status when they switch to Qantas by earning 100 credits in 3 months to qualify for so-called Gold Tier, which offers benefits like lounge access, preferential seating, and priority access and upgrade request. The offer also includes 90 days of free access to the airline's network of Qantas Club lounges and extra checked baggage. Qantas Loyalty Chief Executive Olivia Worth said the airline has seen a spike in requests from people wanting us to match their status with other airlines. And if they are willing to bring their travel across to Qantas, we will fast-track them to Gold status, she said. According to experts, this could help Qantas snag more than 80% of the domestic market over time. Frequent flyers are also apparently unsure of the level of service that Virgin 2.0 will provide after the recent takeover. This strategy by Qantas apparently did not just target Virgin Airlines but more than a dozen other airlines as well, such as Singapore Airlines, Air New Zealand and ANA, among others. According to experts, this event gives a glimpse of the potential battle to come among airlines worldwide over frequent flyers because carriers are now slowly emerging from the crisis. Qantas' share price has been climbing steadily in November with little dips here and there, reflecting optimism among investors even though their revenue and net income has not been looking good recently. And finally, our last news item, tension between India and China goes online. India has recently banned another 43 Chinese apps, including some from famous tech company Alibaba Group. The ban included a number of apps run by the e-commerce giant such as AliExpress, one of its largest malls for overseas shoppers, Taobao Live, a fast-growing video-based marketplace, and more than a dozen of other dating and gaming platforms. This ban puts Alibaba together with the likes of WeChat and TikTok, whose applications were equally banned from the country, and further accentuates India's effort to reduce dependence on China's products and services. Obviously, this is not good for these tech giants who are attempting to expand outside of their own country, maybe to reduce the impact caused by the government's recent regulatory crackdown on large tech corporations around the country. Tensions between India and China have been escalating since earlier this year when some 20 Indian soldiers and Chinese troops were killed in clashes along the Himalaya. And leaders in India's tech industry have also been urging to further protect the interests of local companies against foreign rivals. There have also been claims of these apps engaging in prejudicial activities to the sovereignty and integrity of India. India has also previously blocked 59 Chinese mobile apps, with 118 more banned in September. These include Baidu, Tencent Watchlist, Alipay, and PUBG Mobile. The blacklist has now grown to 200 apps, and it is quite unfortunate for China because India is one of the world's fastest expanding internet markets. So those are the 4 important investment news we had to share with you this week. Once again, we encourage you to get more information if you'd like to act on any of the companies we've shared about earlier. Comment below and tell us what you would like to see on Invest Roundup, and share this video with your friends, especially those who are vested in the stock market. See you again soon!